Good morning, guys. You can see from the sun behind me, the sun is rising on Mount Fukushima behind me. Not sure. Okay, another one of my sessions of Come Learn With Me. This is Greg Saltman for CIOs and Bow Ties. A little bit chilly this morning, all dressed up, looking at articles that everyone liked, shared, and from our kind of top list that everyone enjoyed. And so this one was no surprise to me. It was now a little bit old. It wasn't done. It was first published February 1st, so that's 20 days ago. Unbelievable. But I think it's well worth reading through this article again because I don't think this Reddit crowd has subsided, so there'll still be an impact on the market. But let's go back and let's talk about it and highlight bullet points down below. Usual draw. Silver futures saw 8% rise above $29 as Reddit Hordes pile in. Okay. It was the one print everyone was waiting for, and here it is. Silver futures opened up 7%, surging from $27 per ounce to a high of $29 and 9.5 cents. Following a weekend of speculation that the next big squeeze on Wall Street Bet's radar is silver. And whether that is true or not may no longer matter in a world where, as described below, there's virtually no physical silver to be purchased. Hold on. Get control of the browser again. Here we go. That's short. Silver spikes back to its highest since August-September cycle highs. Gold futures manage very modest gains. And silver's dramatic outperformance has pushed the gold-silver ratio to its lowest since 2014. Silver miners are also getting the love. Australian silver stocks include Argent Minerals and Baobab Metals rise more than 20%. US equity futures are taking a hit, all down 1%. So silver approaches $30. Keep an eye on major price slams emerging either out of central banks who desperately need to keep precious metals lower, or the BIS itself, Bank of International Settlements, whose Benoit Gilson will have a busy day tomorrow. Okay, so the whole theory was a huge short squeeze on silver. For some background, just how unprecedented this weekend's action in silver markets is, Tyler Wall, the CEO of South Dakota Bullion, writes the following: if it's out. In the 24 hours preceding Friday markets closed, SD Bullion sold nearly 10K of the number of silver ounces that we normally would sell in an entire weekend, leading to Sunday market open. So there was a rush for physical. In a normal market, we normally can find at least one supplier or source willing to sell some ounces over the weekend if we exceed our long position. The number of ounces we predict we will sell over the weekend. However, everyone we talk to is afraid of a gap at the Sunday night market open. This is about ready to get really interesting, as there was very little inventory left from suppliers or mints going into Friday's close. Our direct AP supplier informed us after close on Friday that the US Mint will be on allocation for the remainder of Type 1, current Silver Eagle design. Our sales for the month of January exceeded any one month last year during the heart of the pandemic. It was an all-time record month in our company's history. And perhaps most importantly, as QTR tweets so succinctly, this is a red pill moment for many, and it's beautiful. Okay, looks like everything was going to change on that morning, but it seems like very little did in the long run. No. Additionally, there are also signs of a notable regime shift. As Bloomberg points out, investors are holding on to silver they own rather than trying to take profits. Now we are seeing nothing, no single offer, which is scary. Peter Thomas, Senior Vice President at Zayner Group, said by phone from Chicago, whatever we sell, people are holding it. There's no inflow of metal at all. Up to 10:30, it would appear the run on silver has begun. With the market closed, traders have rushed to secure some exposure to silver ahead of the Wall Street bets suggest could be the world's biggest short squeeze, and that has left bullion dealers. As we noted below, the premium for physical silver has soared late Friday into Saturday after massive flows into SLV. But as Sunday rolled around, bullion dealers are now facing massive shortages of physical coin. This rumor of a short squeeze of net short has been on for many, many years, if not decades. So, it's not going to break in a day. And as one investor noted, the shortages are widespread. All online big supplies are sold out. See if there's any meat to this article, or is it just a chronologue? Okay, there we go, the fundamentals. Okay. Right. We're getting there. To the meat. Corner of the market, GV thinks it's possible to squeeze SLV. F after seeing AG and GME, even if you can do it, buy SLV, go all in. The gains will be unlimited demand physical if you can. F the banks. Okay, I guess that was somebody's tweet. And judging by unprecedented flows into the silver ETF that just got started, SLV saw inflows of almost $1 billion on Friday, almost double the previous record of 15 years, which helped prompt spike in SLV off Wednesday lows over 11%. Okay. All right, let's just get a short squeeze. The SLV and SLV call options to buy SLV and SLV call options to force the physical delivery of silver to the SLV box. The silver futures market had oscillated between roughly 100 to 1 and 500 to 1 ratio of paper traded silver to physical silver, but let's call it 250 for 1 to 1 for now. This means that over 250 ounces in open interest in the futures market, only one actually gets delivered. Most traders would rather settle with cash rather than take delivery of thousands of ounces of silver and have to figure out to store and transport it in the future. The people naked shorting silver by the futures market are a couple of large banks, and making them pay dearly for their over-leveraged naked shorts would be incredible. It's not Melbourne Capital on the other side of the trade, it's JP Morgan. Time to get back some payback for all the bailouts and manipulation they've done for decades. Look up silver manipulation fines that JPM has paid over the years. The way the squeeze could occur is by forcing a much higher percentage of the futures contracts to actually deliver physical silver. There is very little silver in the COMEX vaults available to be used to deliver, and if they have time to start buying en masse on the open market, they would drive the price massively higher. There is no way to magically create more physical silver in the world that is ready to be delivered. With the stock, you can eventually just issue more shares if the price rises too much, but this simply isn't the case here. The futures market is kind of the wild west of the financial world. Real commodities being traded, and if you are short, you literally have to deliver thousands of ounces of silver per contract if the holder on the other side demands it. If you remember oil going negative back in May, that was possible because futures are allowed to trade their true value. They aren't halted, and that's what will make this so fun when the true squeeze happens. Okay, 20 days in, the true squeeze hasn't happened. Edit for more detail. Let's say there's one future seller who gets unlucky and gets the buyer who actually wants to take delivery. He doesn't have the silver and realizes it all of a sudden. Damn difficult to find some physical silver. He throws up his hands and just goes long, a matching number of futures contracts, and will demand actual delivery on those. Problem solved because he now has matched the demanding buyer with the new seller. The issue is that the new seller has the same issue and does the exact same thing.